This video will describe how and why a company could raise capital. By raising capital, I'm generally referring to attaining money beyond the profit they might generate from sales. Companies require capital to fund operations, and as they get bigger, they tend to need more of it. There are a few different ways a company can raise that money. They can save the money from operations, save their profits, put it in a bank, sort of like you or I might do, in a savings account. They can ask the bank for a loan. We have the money going the other way since the bank is giving us the money. Or they can take their company and chop it up into little pieces and sell each of those pieces to individual investors. So here's the money. Here are a few investors. Let's give them each 3 pieces and they get the money this way. Let's say we are a shoe factory and currently we produce a single line of shoes. We're doing reasonably well. We make a fair amount of money, but our research department has come to the realization that we could make a lot more in sales if, in addition to the original line of shoes, we also made sandals. However, we only have a factory that produces shoes. So what do? We need to now create a new factory. Looks like the roof didn't come with us. But creating a new factory requires more money. Let's see if I can draw like a sandal here. There's our sandal. Pretty elegant. So how can we raise money for this new factory? Well, the first option that is to continue to just put money away from our shoe factory into the bank, or we could ask that same bank for a loan, or we could ask many investors for a loan in the form of a bond, or we can sell off part of the company in exchange for capital, which we'll then use to finance operations. So let's use that third example and use that going forward. The first option is the safest, but will take the longest amount of time. The second option, a loan or a bond, might be compelling for a number of reasons. Chiefly, we're not giving up part of our company. The third option, though, let's focus on that for a moment. In this case, what we're doing is chopping up the company into small shares and selling off those shares to individual investors. Those investors are hoping that once this company turns a profit, that each of those shares will be worth more money. The shares, by the way, are a claim on future profits, and we'll discuss things like dividends and other rights and responsibilities of shareholders in a separate video. Now the question is, who are these people that we're selling the company to? Are they public or private investors? Well, private investors are people like VC firms or private equity firms. You may have heard of a few of these firms in the media, particularly with startups. The difference between these and the general public is that when we have a private investor, we generally don't need to reveal as much information about our company. This is generally a good thing because we don't want our competitors to know what we're doing. We don't want them to know our financial strength or our business plans and see how that strategy is important to keep. The downside is that the private investor typically doesn't have as much money as the collective public. There's obviously far more people in the public than there are in the private. And the private investors may demand terms that are unfavorable. For example, they may ask us for more ownership than we're willing to part with. Let's say they want 2/3 and we want 1/3. Well, that's pretty unfavorable. If this is the first time we're selling stock to the public, we're executing an initial public offering, also known as an IPO.